This is quite a busy cover page. This video is going to be quite busy and hopefully a great introduction to the contents of this video. I hope you guys, like me, are getting time to exercise with your friends and share a cup of coffee at the end of your exercise. In this video, I'm going to introduce cost of sales. What is a markup? How do you calculate markup percentage? What is gross margin and how do you calculate it? What is gross profit? And then also I'll give you an explanation of what the perpetual inventory system is and how we keep records of stock in the perpetual inventory system. So this is going to be quite a busy video. Hopefully the penny will drop, the coin will drop, and this will be a good foundation for the points that I have already mentioned. Through two transactions, if you have a look down here at this picture of Caleb sitting on a table he's bought, let's pretend Caleb is buying and selling furniture and he has bought this table and he's going to sell the table. So the two transactions which I'm going to use to explain cost of sales, how to calculate gross profit, markup percentage, and gross margin. I'm going to use two transactions, the buying and selling of this table that Caleb has bought. Then I'll just briefly mention what a perpetual inventory system is. And by the way, perpetual means ongoing. And you'll see the advantages of using a perpetual inventory system. So the next few slides, I'm going to cover the points in red, and hopefully you will understand what I'm saying, as we will use these terms or calculations in red quite often in business. Let's start at the beginning. Cost of sales is categorized as an expense. Now, if I look at this transaction, Caleb buys 3 tables from a manufacturer and pays 1,000 Rand each. The cost price of each table is 1,000 Rand. Remember, Caleb is in the furniture business, so the tables that he is purchasing, 1,000 Rand each, 3 tables, is his stock, right? What you buy and sell is your stock, and the correct terminology or account name is trading inventory. So that's your stock, your merchandise that you're buying and selling. This stock was bought for cash. We're ignoring any taxes. So Caleb, or Calebu Education, is sitting with 600,000 Rand from prior transactions in their bank account. So 3 tables are purchased, 1,000 Rand each. Let me quickly show you what happens here. I'm using T accounts to explain this. But the bank balance will decrease. I'll even explain using some rules. I'll do a separate video on rules, but let's get into the rules. Our bank balance, by purchasing these 3 tables, has decreased by 3,000 Rand. Our rule with regard to assets, if the value of the asset decreases, the account will be credited. That's why this 3,000 Rand is on the right hand side, because the bank balance has decreased by 3,000 Rand. The contra account, as I've explained before, to bank in this transaction is trading inventory. You will need to write that out. And then the account bank was credited. Trading inventory is an asset. The value of our asset trading inventory has increased. So an increase in assets with regard to trading inventory, we've purchased stock, 3 tables, 1,000 Rand each. We now have a current asset trading inventory of 3,000 Rand. The value is 3,000 Rand of our stock. And the contra account that says bank is the contra account to trading inventory is bank. And the contra account to bank after this transaction is trading inventory. I've explained the link between accounts with transactions, contra accounts. So these two accounts are contra accounts to each other. Now, let me explain that in English. We've bought trading inventory for cash. Our bank balance decreased by 3,000 and the value of our stock increased by 3,000. You will see on the next slide, I've typed it out so it's nice and neat. But this slide here and this transaction that I've just recorded was the purchase of stock, and the purchase was made using cash. So after the purchase of the 3 tables, the trading inventory account has a balance of 3,000 Rand worth of stock. There's that entry we did in the previous slide. Our bank balance decreased by 3,000 Rand because we purchased stock, right? Trading inventory. Now, 1 table gets sold for cash, and it's sold for 1,500 Rand. So now what we need to do is we need to record the sale. So we have a sales account here. Sales is income, and you will see our income has increased, and the rule, an increase in income, we must credit the account. How much did we sell a table for? 1,500. What was the contra account? Bank. Because we sold this for cash. So what happened to our bank balance? Our bank balance increased by 1,500, and the contra account was sales. That says sales. The account was debited because bank increased. The value of our bank balance increased. There was an increase in asset. Bank is an asset. So there was an increase in our bank balance of 1,500. The account must get debited. So it's on the left hand side, the entry. And sales was credited. The entry goes on the right hand side in the account because there was an increase in income. But that's only the first part of this sale. Is our stock still valued at 3,000? That consisted of 3 tables that we purchased. But now we've sold 1 table. So we need to record that fact. And at this point of sale, the stock is expensed. So the contra account to trading inventory, we open up a new account called cost of sales. There is cost of sales. So when we record the fact that we've got rid of 1,000 Rand worth of stock, in this case it was a table, we say that the asset trading inventory is expensed. We're going to show that 1,000 Rand as an expense. It was the cost of the sale. So in cost of sales, remember, cost of sales is an expense. An increase in expense, the rule says it must be debited, and it will be 1,000 Rand. And the contra account is getting messy here, but I will show you a typed out answer. So trading inventory was credited because we got rid of a table. If I did a quick balance here, the stock's now worth 2,000. 3,000 minus 1,000 is 2,000. And cost of sales was debited with the cost price of the table that we sold. And we sold it for 1,500. So from the previous slide, a table got sold for 1,500 Rand. So there are two parts to the sale. I did scribble it down on the previous slide, but I've typed it out neatly here. The sale was for cash, so our bank balance increased by 1,500 Rand. The contra account was sales, so bank was debited, an increase in assets. Sales was credited, an increase in income. So in the sales account under details we have bank, the name of the contra account, and the amount was 1,500. So bank was debited and sales was credited with the selling price 1,500. Now at the same time, we didn't actually get this sale for nothing. Our profit is not 1,500. There was a cost involved, and the cost of the sale was the cost price of the table that we are selling. So in the trading inventory account, we had 3 tables, 3,000. We originally purchased 3 tables. Now we sold 1 table. So the 1 table, the cost price was 1,000. We credit trading inventory, decrease in the value of our assets, 1,000. And at this point of sale, we convert or we expense this asset to show that there was a cost to the sale of a table for 1,500. There was a cost of the sale, and it was the cost price of the item that we are selling. So we debit cost of sales and an increase in expense. The rule says debit. That's why I have the 1,000 Rand on the debit side, and the contra account is trading inventory. So there we go. I've explained it again, but I typed it out neatly, and I most probably made a mess of it with all my writing, but hopefully the scribbling explains here what's happened. If we balance this trading inventory account, the balance would be 2,000, as there are 2 tables left, 1,000 Rand each. That's the value of our stock. If I balance this account, there would be 600,000, actually 601,500 minus 3,000 will give you the balance of what should be in our bank account. The income that we've earned is 1,500, but there was a cost involved, and the cost of the sale was the purchase price of the table when we bought it from the factory, 1,000. So that was the original cost price of the table that we sold. It's the cost of the sale. Remember, we're looking at a trading concern, so we're buying and selling. Cost of sales in a manufacturing concern would be calculated differently. But at this stage, we're only looking at a simple buy and sell, a trading concern. So here is Caleb just before he made the sale. He's saying goodbye to his table and waiting for the customer to pick up the table. So from the previous transactions on the previous slides, we can get or obtain the cost price. The cost price of the one table was 1,000. The markup was 500 and the selling price was 1,500. So cost price plus markup is equal to selling price. We had 1,000 plus a markup of 500, and that is equal to 1,500. Now we can calculate what was the markup percentage. And in order to do that, we say the markup divided by the cost price, and if we want a percentage, we multiply by 100. So in this case, the markup was 500. The cost price was 1,000. So 500 divided by 1,000 multiplied by 100 is equal to 50%. So the markup percentage, if you ask to calculate the markup percentage, you say markup divided by cost price multiplied by 100. And in this case here, it is 50%. Now if you ask to calculate the gross margin, that is the markup on the selling price. This example here was the markup on the cost price. Now the gross margin is the markup on the selling price. So we know the markup here is 500 divided by the selling price. In this example, the table was sold for 1,500 multiplied by 100. So the gross margin, the markup on the selling price, in other words, the gross margin, is 33.33%. And if you want to calculate the gross profit, that means the gross profit, I'll tell you now, is selling price 1,500, sales minus cost of sales minus the cost price in this example of 1,000 is equal to 500. Now gross means it is the profit before we take off operating expenses. For example, a person's salary, the telephone account. So gross profit is simply sales minus cost of sales. And in our simple example, we sold one table and the cost of the sale was 1,000 and the selling price was 1,500. So the gross profit or markup is the same thing as gross profit, is 1,500 minus 1,000 is equal to 500. That's the gross profit. Using the perpetual inventory system means we are able to calculate the cost of sales after every single sale. So if we look at the example from the previous slides to explain the perpetual inventory system, if you remember, we bought 3 tables, 1,000 Rand each, which means we have stock in total value. The total value of the stock is 3,000. But what happened was we sold a table for 1,000 and there was a cost of sale. Now the perpetual, which means ongoing inventory system, enables us after every single sale to calculate what stock we should have on hand. If we did a a stock take. So there's an advantage of using the perpetual inventory system. We are able to determine in our books what our stock level should be, the value of our stock, what it should be. And in this case, after that purchase of stock and the sale of stock, the balance of our stock will be 2 tables, which comes to 2,000. So you also get another inventory system called the periodic inventory system, and the disadvantage of that is you calculate your cost of sales at the end of the period. So most people try to use the perpetual inventory system because you can calculate the value of your stock after every sale. Thanks everyone. I hope you enjoyed this presentation.